Sam Altman, the CEO of OpenAI and unofficial high priest of the AI cult, recently made a rather surprising admission. He told reporters that, quote, "When bubbles happen, smart people get overexcited about a kernel of truth." That is essentially the billionaire way of saying everyone has lost their minds. It is a strange thing to hear when the US stock market has nearly doubled in the last 5 years. Most of that growth comes from 10 giant tech companies promising that artificial intelligence will rewrite the rules of modern business. If you read the financial press, you would think this surge in market capitalization is direct evidence of the value AI is creating for society. However, judging the quality of a technology by its stock price is like judging the quality of a restaurant by how expensive its forks are. When a company's valuation jumps by hundreds of billions of dollars, that money doesn't magically materialize in a vault somewhere. It simply means the last person to buy the stock paid more than the person before them. A $10 price tag on one banana only proves that a single buyer is about to have an expensive smoothie. It fails to change the inherent value of every other banana on the planet. Stock charts measure sentiment, not reality. To figure out what we are actually buying, we have to put the financial hype aside and run a physical ledger. We need to measure the hard metal and electricity going into this machine and weigh it against the actual output it produces. The infrastructure required to run large language models is built from metal, silicon, and massive invoices. In 2024 alone, just 4 companies, Amazon, Meta, Google, and Microsoft, spent roughly $344 billion on AI infrastructure. That represents more than 1% of the entire GDP of the United States. And those are just the public numbers. When you factor in China's state-owned build-outs and global chip sales from manufacturers like NVIDIA and AMD, the rest of the world has matched that pace. We have officially crossed the $1 trillion mark on hardware alone. But you cannot power a server farm with dollar bills. This hardware runs on electricity, and that is where the physical bottleneck begins. Right now, global data centers are consuming roughly 1.5% of the entire world's electricity. The International Energy Agency expects that number to double by 2030. This chart visualizes the capacity of modern power grids. On the right, China operates a relatively new grid with a 100% reserve capacity, meaning they can easily plug in millions of new processors. On the left, the United States relies on a grid largely built in the 1960s and 70s. It operates with a reserve capacity of barely 15. Analysts project that at the current rate of expansion, the AI boom will hit a literal wall by 2028. There will simply be nowhere left to plug these machines in. The technology industry is operating as if resources are infinite, aggressively pushing our physical power infrastructure to its breaking point. If you are going to spend over $1 trillion and strain the global power grid, you need to produce something spectacular. So what exactly is this machine outputting? This chart breaks down a recent MIT report called the Gen AI Divide. It reveals that 95% of companies using generative AI tools got absolutely zero return on investment. The vast majority of these integrations look great in a controlled demo, but fail to generate any real financial value. The moment you draw large language models into real, multi-step workflows, they buckle. Researchers are finding that while these models handle short prompts well, they degrade rapidly during complex tasks, generating errors and security vulnerabilities. Software engineering was supposed to be the perfect use case. Instead, development teams are now hiring human code janitors just to clean up the messy, buggy outputs the AI generates, the exact jobs the technology was supposed to automate. Building a business on this foundation is incredibly risky because the platforms themselves are unstable. When OpenAI pushed out major updates, it quietly broke support for countless custom developer tools overnight. So if the returns are hovering near zero and the costs are measured in trillions, logic dictates the spending should stop. The only thing filling the gap between reality and valuation is the fear of missing out. Corporate executives watched their competitors slap the words AI-powered on products and instantly receive a stock bump. To soothe their own investors, they rewrote budgets and rebranded teams. In private markets, you do not even need a working product to raise hundreds of millions of dollars. You just need to tell a story about building the future. Corporate boards are currently prioritizing a story of future dominance over the reality of zero returns, maintaining high valuations through sheer market momentum rather than functional software. Every bubble eventually runs out of capital, and this one will run out of electricity too. Even optimistic analysts expect that the mega-cap tech firms will soon be forced to slow their spending as they collide with the hard limits of both the power grid and their balance sheets. We have a historical blueprint for exactly how this ends. During the dot-com bubble of the late 90s, companies simply added .com to their names to double their valuations, completely detached from their actual revenue. When that bubble popped, it wiped out thousands of startups that were little more than pitch decks and expensive mascots. But out of that rubble, a few quiet survivors, like Google and Amazon, took the underlying technology and built the actual infrastructure of the modern internet. The exact same dynamic is playing out now. The flashy, half-baked chatbot applications and overvalued copilots will disappear. The companies that survive will be the ones that stop trying to automate everything and instead focus on making one specific, valuable task faster. A market correction will likely eliminate the speculative startups, leaving behind a permanent infrastructure of chips and power lines to support more efficient utilitarian tools.